You ever see those videos that are like, this is the only thing you'll need? This one indicator, this one thing is everything. And thought to yourself, is that like, could it actually be like that simple? In this video, I want to unpack that and talk about the realities of the one strategy approach. Can it actually be done? And pose a couple questions to you. And it's a bit of a different spin based on what you may have thought this video was going to be like, but I encourage you to give me a few minutes, hear me out. This will be useful. All right, so to frame this properly, let me give you a simple dollar cost average investing strategy approach. Not trading, this is investing. And let's say that you were to get paid bi-weekly, or let's just say on average twice a month, and every time you get paid, you put a set amount of money into your brokerage account, and you simply buy the S&P 500. Let's say you buy SPY, the S&P 500 ETF, and you just do that no matter what the price is when you get paid. That's it. Simple approach. Done. That's it. Nothing else. That would be like a one strategy approach to your investing portfolio and to your long-term investing plan. If you take a step back, do you actually need anything else? Like, is that fine? Like, would that do? Or do you just fine? You would do better than the majority of people who are trying to play this game, that game, shiny object here, shiny object there, and you would just kind of ride whatever the market does. You'll go through bear markets, you'll go through bull markets, and you'll ride whatever the average is. And over the past 100 years, it's around 10% per year. Now, switching gears to trading, which are two different things. Investing and trading are not the same. Don't confuse them. I make that very clear. At least I have the past like 2 years making videos. But in that space, let's say you have a simple trendline break strategy on the precious metals, let's just say gold, silver, platinum, whatever, and you trade that based on the 4-hour time frame. So you only look at 4-hour charts. That's all you look at. You trade gold, silver primarily, and you wait for trendline breaks. You draw in trend lines, 3+ touches on the 4-hour time frames, and when you see breaks in those trend lines, you take trades. And you have a strategy, build a strategy around that, and that's your only strategy. Now, the strategy is well defined, but I know what you probably are thinking. How often will this strategy present itself? Because it's pretty defined, right? Like, when you dive into defining it really, really well, like, that's good in theory, but then, like, how often are you going to get that set up? And then will you play both sides? Will you go long and will you go short? Because if you play both sides, that in theory would maybe double or roughly double the amount of trade opportunities that you would then get. And will the strategy work the same? Is it the same thing? Just like inverse the charts. Like could you just in theory just say, when I'm shorting, I could just look at the inverse chart and just it's the same as a long that I would take on gold or silver or whatever metal I'm trading. Like, that's kind of the idea. Those questions, the how many times it presents and can you replicate it on the long and the short side, are actually very important in the longevity and the ability to replicate the strategy. Because if you don't have that repeatability aspect, you're very likely, or you're substantially higher likely to jump ship, change strategies, and completely spiral because you don't have enough trades, or there's just not enough for you, and so you're chomping at the bit to do more, and you're looking for things that may not be there. So, okay, back to the original question. Is that one strategy all you need? The answer is a bit nuanced, and there's a few different parts, but first, the sponsor of our video, Iron Beam.
Welcome to Iron Beam, the future of futures trading. With our cutting-edge chart trading feature and 300+ indicators, you can now trade directly off the chart anytime, anywhere. Delivering seamless trading across all platforms, the Iron Beam journey is supported by 24-hour trader support, low day trade margins, and no account minimums. Iron Beam brings the future into the present. Join now and augment your trading experience.
Given a strategy can be traded long or short and will present itself enough times on a day-to-day, week-to-week, month-to-month basis, sure, one strategy is all you would in theory need. But I've also been around long enough to experience something else that may not be as promising for the one strategy approach, and that would be the changing market conditions that we have to deal with all the time. In English, what that really means is your strategy that you had is just not working. Like, it stops working the same way. So changing market conditions means the same strategy that was playing out nicely, let's say the trendline break strategy, which is very simple, but let's say you did that, or you want to go ICT concepts and complicate the shit out of yourself. It's up, everyone's going to have their approach. Not that that's bad or that the trendline strategy is bad. People I've seen do both and make money. It's not like it's impossible. I do neither, but that's me. And there's a million ways to do it. The logical approach when things are not working is to change it, to change your strategy, whether that's making little tweaks, a little adjustments here where you put your stop, take profit, or complete overhauls of your strategy. Once you do that and figure things out and get things back on track, the market changes yet again and things stop working yet again, and you have to make an additional tweak or overhaul. I'm sure we've all been there to some degree, but in my head, it leaves us with 3 options. Option 1 is to chase your tail. Keep changing your strategy, keep making tweaks or making overhauls, and keep running in circles, changing. I've been there, and it was not profitable. Doesn't mean it can't be, but that was what I found in my own experience. Option 2 would be to stay firm to your strategy and just manage your risk. If you can make more when things are working well and manage your risk so that you lose less when things aren't working well, and just let the market cycles repeat over time and let them change and let your strategy kind of be good and bad and good and bad, and just manage when it's bad, manage when it's good, and milk it out, you could also, in theory, make money and don't need to change anything. You can just trade that same strategy, which people absolutely do. And there's a lot of people who have been doing things for a very, very long time who operate that way. Or option 3 is stay firm, but use discretion. Discretion is really just the freedom to decide what to do in a given situation. So you might have your strategy, which you stay firm with most of the time. But then as market conditions change, you're able to make those little tweaks here and there. And in my experience, what I've seen in my own examples, my own life, and then in people who are much, much more successful than me and have been doing things much longer than me, it's kind of a blend of 2 and 3. Why do I believe that is the case? It's because the game is so much more about how you manage the risk versus how many times you could be right, or being right on this trade versus that trade. It's so much more about how you manage when things are not working or how you adapt to the changing market conditions. Over time, you'll have seen things change so much, and you'll be able to kind of use discretion to your advantage because you've been around, you have the experience, and you've seen similar situations arise in the past. Does it mean that you completely disregard all of your rules? No, you just kind of bend the lines a little bit. You bend how you enter, you bend how you exit, you bend the way you manage it. Maybe instead of having, a 2-part take profit, you just take profit at one spot, or you have a trailing stop on your exit. It's little things like that, which in the grand scheme might not be a big difference, but they can make the difference, especially as those market conditions do change. And this is also a product of experience. The longer you've been around, the longer you've been trading one way, the more you can see the nuance, you can see the ways that you can change or adjust your strategy to these different conditions when they arise. And someone who is new just doesn't have that experience and doesn't have kind of the ability to use discretion properly because they just don't have the experience and haven't been doing it long enough. And they're much more likely to fall out of sync and then end up spiraling because they stray too far away from their original strategy. I hope that made some sense. I will also link up the sponsor and any resources below this video. And if you feel like trading is super lonely, which I definitely think it is at times, this video will dive deeper into understanding why that is the case and what you could do about it.